What happens when 1.2 million households discover they can't afford their homes anymore? Right now, across Canada, 60% of all mortgages are scheduled to renew in the next 24 months. In Vancouver alone, hundreds of thousands of homeowners who locked in pandemic rates at under 2% are about to face renewal rates exceeding 5%. We're talking about payment increases of 40% to 50%, hitting families already spending more than 100% of their income on housing costs. This isn't a correction. This is a complete systemic breakdown that Premier David Eby's government cannot control and cannot stop. $400 billion in mortgage debt comes due in 2026 alone. The International Monetary Fund already identified Canada as having the highest mortgage default risk in the developed world. Banks just increased their provisions for defaulting loans by 64% to $4.1 billion. They know what's coming. The question is, does anyone else? Today, you're going to see the exact mathematics of financial destruction. The real families watching their equity vanish while payments explode. The unprecedented mortgage stress data that proves Vancouver is heading toward the worst housing collapse in Canadian history. And why Premier Eby's administration has absolutely no tools left to prevent the catastrophe that's now just months away. Subscribe right now and smash that like button because this mortgage meltdown is accelerating faster than anyone predicted, and you cannot afford to miss what happens next. The numbers are absolutely brutal and there's no way to sugarcoat them. A $500,000 mortgage that costs $2,313 monthly at 2.79% will jump to $3,437 at 6.79%. That's a 49% increase in a single renewal cycle. Think about what that means for real families. Someone who purchased an average Vancouver condo for $750,000 in 2021 with 10% down has a mortgage of $675,000 at 1.79%. Their monthly payment was roughly $2,750. When that mortgage renews in 2026 at 5%, the payment jumps to approximately $3,950. That's an increase of $1,200 monthly or $14,400 annually. Hit that like button right now because the real life stories I'm about to share will shock you to your core. For a household earning $120,000, that extra $14,400 represents 12% of their gross income before taxes. But here's what makes this catastrophic. That same condo purchased for $750,000 is now worth perhaps $720,000, down 4% year over year. After 4 years of payments, their mortgage balance sits around $640,000. They have $80,000 in equity, barely more than their original $75,000 down payment. If they need to sell, realtor fees of 3% to 4%, plus legal costs consume $25,000 to $30,000. Their equity completely vanishes. They're trapped. Unable to afford the higher payment, but also unable to sell without bringing cash to closing that they simply don't have. The Bank of Canada's own analysis confirms the devastation. Homeowners renewing in 2025 will see average monthly payment increases of 10% compared to December 2024 levels. In 2026, it moderates slightly to around 6%. But these are averages that mask extreme variation. Fixed-rate mortgage holders who locked in 5-year terms at historic lows face the most significant impact with typical payment increases between 15% and 20%. For those with variable-rate mortgages with fixed payments, it gets even worse. About 10% of this group could see payment shock exceeding 40% in 2026 as their loans reset at higher principal amounts. These aren't minor adjustments. These are life-altering financial shocks that will force impossible decisions on hundreds of thousands of families. Vancouver faces unique amplification of this crisis. The Metro Vancouver benchmark price sits at $1,504,000 as of August 2025, even after recent declines. Prices remain 43% higher than a decade ago. When mortgage rates change in this market, effects are dramatically amplified. A 0.5% rate change on a $1 million mortgage alters monthly payments by $800 to $1,000. For households already stretched beyond their limits, that difference determines whether they keep their home or face foreclosure. Canadian household debt has reached 180% of disposable income, the highest in the G7. Consumer debt hit $2.54 trillion at the end of 2024, up 4.6% from the previous year. More than one-third of recently issued mortgages now have a debt-to-income servicing ratio exceeding 25%, double the rate from 2019. Hit that like button because the banking sector data I'm revealing next proves the entire system is on the verge of collapse. Banks have increased their provisions for defaulting loan debt to $4.1 billion from $2.5 billion a year earlier, a 64% increase. This isn't precautionary. This is banks preparing for a wave of defaults they know is coming. Expected credit loss allowances now surpass levels seen during the pandemic and approach those of the global financial crisis. Reaching 0.26% of outstanding mortgages as of Q3 2024, Canadian households took on 17% more credit card debt on average since 2020. Arrears on credit cards have returned to pre-pandemic levels with 2.22% of non-mortgage holders in arrears compared to 1.05% for mortgage holders. About 45.68% of Canadians without a mortgage carry an outstanding credit card balance, and 23.03% carry a balance exceeding 80% of their borrowing limit. Consumer insolvencies rose 6.1% in Q4 2024 compared to the same period in 2023. Over the 12-month period ending September 2024, insolvencies surged by 15.4%, highlighting the growing inability of households to manage debt obligations. Business insolvencies escalated even more dramatically, rising 48.6% over the same period. Key industries, including manufacturing, construction, and retail, have been disproportionately impacted, suggesting financial instability is spreading beyond households to corporate balance sheets. The mortgage stress test introduced to protect borrowers from exactly this scenario has proven completely inadequate. All borrowers since 2018 had to prove they can afford mortgage payments at interest rates significantly higher than their actual contract rate. Currently, borrowers must show their income is high enough to handle payments based on a rate of 5.25% or the contract rate plus 2%, whichever is higher. But here's the fatal flaw. This test only applies at the time of purchase or refinancing. Borrowers who renew with their existing lender don't need to requalify. This creates a perverse situation where a borrower who locked in at 1.79% in 2021 and could handle the stress test at 5.25%. At that time now faces renewal at actual rates of 5% or higher. But their financial situation has deteriorated. They've taken on more debt. Their income hasn't kept pace with inflation. The cost of everything else has increased. The stress test said they could handle 5.25% rates in 2021, but that was theoretical. Now it's real, and many are discovering they absolutely cannot afford it. Canadian real estate investors accounted for 30.4% of all home buying transactions in Q1 2024, setting a new record. In Vancouver, where investor participation was even higher during the boom years, many of these properties are now bleeding cash at catastrophic rates. Share your experience in the comments because what's happening to investors will crash the entire market. According to recent data, 81% of leveraged condo investors in the Greater Toronto Area are now in negative cash flow, losing an average of $597 monthly. While specific Vancouver data isn't published, local real estate agents report similar or worse patterns. Investment properties have a dramatically higher propensity for default when cash flows turn negative. When an investor is bleeding $1,000 to $1,500 monthly on a rental property with no appreciation and no equity, the rational decision is often to walk away, especially if they have multiple properties in the same situation. For Vancouver specifically, the mortgage crisis intersects with another devastating problem: the condo oversupply. According to Canada Mortgage and Housing Corporation data from October 2025, approximately 2,500 newly built condos sit unsold and empty across Metro Vancouver. That number has doubled in just 12 months. Industry professionals describe this as the highest level of developer unsold inventory in 24 years. The last time the market saw numbers like this was 2001 during the dot-com crash. These unsold condos represent more than just excess supply. They're evidence of a fundamental mismatch between what was built and what buyers can afford. Many of these units were designed for investors with small 450 to 500 square foot layouts optimized for rental yield. But investor participation in Metro Vancouver's condo market collapsed from 50% of buyers between 2021 and 2023 to just 7% in early 2025. The investors who once bought presale units by the dozen have completely fled the market. The broader economic outlook adds further uncertainty. Trade tensions between Canada and the United States create risks for the Canadian economy. Potential tariffs on Canadian exports could erode trade revenues and drive job losses in export-dependent industries. This would weaken consumer confidence, discourage discretionary spending, and prolong economic stagnation. If unemployment rises while mortgage payments increase, the combination could trigger a wave of forced sales that overwhelms the market's capacity to absorb them. Looking forward, Vancouver faces a perfect storm with absolutely no resolution in sight. The mortgage renewal wave will peak in 2026, with $400 billion in mortgages coming due nationally. Vancouver's share of that is substantial, given the region's astronomically high property values and the concentration of mortgages originated during the 2022 buying frenzy. Subscribe right now, because what happens in the next 12 months will determine whether Vancouver's housing market survives or enters a decade-long depression. Even if interest rates fall from current levels, they're unlikely to return to the sub-2% rates. Many borrowers locked in the gap between pandemic-era rates and renewal rates will remain massive and destructive. The supply situation provides zero comfort. With 2,500 newly built condos sitting unsold across Metro Vancouver and developers continuing to complete projects that were started during the boom, inventory levels will remain catastrophically elevated. High inventory with softening demand creates relentless downward pressure on prices. For homeowners hoping to sell to escape mortgage stress, this means accepting dramatically lower offers or watching properties sit unsold for months while carrying costs accumulate. Housing affordability data shows the average Vancouver household needs to spend 106.3% of its income to cover homeownership costs. This is mathematically unsustainable. Something absolutely must give. Either incomes must rise dramatically or housing costs must fall dramatically. Income growth shows zero signs of accelerating. That leaves price adjustments as the only path to equilibrium. Some analysts suggest the worst-case scenarios have eased, arguing that recent data shows the average mortgage payment climbed 4 points less than the Bank of Canada originally forecast. They claim the mortgage renewal cliff is more like a curb with manageable increases rather than catastrophic shock. But this optimistic view is dangerously premature and ignores reality. The calculation of average payment increases masks extreme variation. For borrowers who locked in at the absolute lowest rates and are renewing at the highest current rates, the shock is absolutely severe and potentially fatal financially. A borrower with a $500,000 mortgage at 1.79%, paying $2,115 monthly, who renews at 4%, will pay $2,544, a 20% increase. For a borrower at 2%, renewing at 5%, the increase approaches 30%. These aren't abstract percentages discussed in government offices. They're real dollars that must come from somewhere in already devastated household budgets. Premier Iby's administration is caught between impossible choices. Intervene aggressively with subsidies or rate relief and risk exploding provincial debt during record deficits. Maintain current policy and watch constituents lose their homes while tax revenue collapses from declining property values and transaction volumes. The 2026 mortgage crisis isn't a future possibility anymore. It's happening right now, unfolding in devastating slow motion as renewal dates approach. The homeowners who locked in pandemic-era rates are receiving their renewal notices, seeing the new payment amounts, and realizing their financial situation is about to change catastrophically and permanently. By mid-2026, historians and economists will look back at this moment as the inflection point when Vancouver's housing market crossed into territory from which recovery became impossible without revolutionary intervention or complete market collapse. The assumptions that built this market have all exploded. Tech employment won't expand indefinitely. Foreign capital isn't permanent. Population growth isn't guaranteed. Prices don't always appreciate. Interest rates don't stay low forever. The math is brutal and unavoidable. Vancouver households already spend 106.3% of income on housing. Adding another 3.5% to 15% for mortgage renewal, shock pushes them into complete financial crisis. The only questions remaining are, how many families will lose their homes? How far will prices fall? And how long will the recovery take? Premier David Eby's government has lost control of this situation. They have no policy tools powerful enough to prevent what's coming. The mortgage renewal wave is too large. The household debt levels are too extreme. The price-to-income ratios are too distorted. The system is breaking in real time, and everyone in power knows it. So here's my question for you. Can anything stop this financial catastrophe, or are we watching the beginning of Vancouver's greatest housing collapse in history? Are you facing mortgage renewal shock yourself? Share your story in the comments right now because your experience matters and others need to know they're not alone in this crisis. Don't forget to subscribe and hit that notification bell because what happens over the next 12 months will be absolutely historic and you cannot afford to miss a single update. I'll see you in the next one.